a tale of two stocks. 3M today reported the stock fell 11%, the biggest loser on the S&P. Netflix just reported after hours. Coupling it with earlier today, they're up over 10% total for the day during trading and after hours. Let's understand who should be excited, because I can understand you 3M investors out there a little scared seeing your stock go down 11%. And the Netflix guys out there, especially one guy in our community, loves Netflix, probably pumped up to see his stock up so high. Let's break them down. Now for 3M, let's look at this right now. They have their generic stuff at the top here, all the corporate stuff they say, but here's some interesting things, guys. Their GAAP earnings per share, this quarter, $1.70. Last year, same quarter, 98 cents. Almost double. Net costs, all these special items, adjusted earnings per share, $2.18 versus $2.42 this quarter. So a sizable jump. That is 10%, over a 10% increase. GAAP operating income margin, 7.8% last year, 15.5%. Operating income, guys, is earnings before interest and taxes. This shows you how is the company fundamentally doing. Are they becoming a better business? Now, it's not all rosy. Let's look at this. Net sales. GAAP was $8 billion. Sounds great, but the change was 0.8% decrease. Organic sales down 1.9%. Their acquisition sales added 0.2%. So that's kind of a concern. You want to make sure the business fundamentals are getting better. So does this tell us exactly why the stock went down 11% today? No, but here is why. The reason for the fall was management's financial guidance appears to be that reason. Adjusted EPS for 2024 is expected to be about $9.55, while Wall Street was looking for $9.90. Remember, guys, the guidance of a company to Wall Street's numbers can really drive a stock up or down. So the profit is going to be about 5% less, and the stock went down 11%. Is that rational? I don't know. You have to understand if the stock is reasonably priced at these levels. But let's check out what this article says. Investors should remember, though, that while EPS guidance was light, 3M tends to be conservative with their guidance. At the start of 2023, management had guided to about $8.75 a share in profit, and the final number was $9.24. That is 50 cents higher per share. Also, another silver lining. Guidance on free cash flow and sales looks solid. Free cash flow is expected to be north of $5 billion in 2024. Remember, free cash flow is a lifeblood of the business. It's cash from operations less your capital expenditures. And on top of that, sales are expected to grow 1 to 3% organically, which compares to the drop of 1.9% in organic sales. Organic sales, remember, are the natural growth without acquisitions, just the natural regular business growing on its own. So they're going back to growth in that guidance. Now let's go to Netflix real quick and see what's going on. And following that, I will give my financial opinion on both these stocks. Guys, Netflix is up 5.5% after hours. At one point, it was up 7%. Now, let's take a look at the numbers. $2.11 earnings per share they just reported. Guys, guess what? They missed. They're expected to do $2.22. $8.87 billion in revenue reported, beating expectations of $8.31 billion. But most importantly, guys, they added 13.1 million subscribers when the market was expecting 8.9. Their new ad-based system is working very, very well. This is Netflix report. Guys, a lot of great information here. They accelerated their growth, exiting the year with 12% revenue growth. 12%, when in 2022, they only did 6%. Back to the big growing machine. They grew their operating margin. Remember what operating margin was before. It's earnings before interest and taxes, to 21% from 18%. Guys, 3% growth on $8 billion, $9 billion in revenue is a huge, huge number. Major kudos to that great company. And they increased their free cash flow to $6.9 billion for all of 2023. Another monster year because free cash flow was always hard for them. And of course, you all saw the big news today. They just signed with WWE a 10-year, $5 billion contract to be exclusive providers of WWE for their users. That's probably going to add a bunch of people getting Netflix. Guys, one really exciting thing I saw on Netflix that I love reading, I hope it's true. As a reminder, the quarterly guidance we provide is our actual internal forecast. So what they're saying is, guys, we're not lying to you here. We're not giving you guidance out there that we don't believe in. It's our actual internal forecast at the time we report. Our primary financial metrics are revenue for growth and operating margin for profitability. Our goals are to sustain healthy revenue growth, expand operating margin, and deliver growing free cash flow. Guys, this is what an investor wants to hear. But keep in mind, just because this is the case doesn't mean that any price works for it. You still have to pay the right price for the company. These are awesome to read. It tells me that Netflix gets it. It's about giving value to shareholders, and that's important. And I love reading that. What I loved about 3M is 3M sat there and said, guys, we settled all these lawsuits, we got rid of a lot of these things, and we're restructuring to make ourselves a better company. Doesn't mean it'll happen for sure, but if they're able to do that, they could be a lot better company. Now let's go check out further along here. Revenue. Q4 2022, 7.8 billion, then 8.1, 8.1, 8.5, and 8.8 last year, and their last quarter, and they're forecasting this first quarter to be 9.2 billion, which would be an increase of 13.2%. They're expecting operating income, record operating income in Q1 of this year, 2.4 billion. Just look at Q4 of 2022. Just 3 years ago, 2.5 years before, $550 million. They have really done a great job of driving that operating income, and that matters so much about the fundamentals of the business. That's what's so great about Netflix. I feel the numbers are starting to support what a great company it is, the great content they provide. Look at their operating margin. 7%, 21, 22.3, 22.4, a little bit lower this last quarter, but they're forecasting 26.2%, a record for them over here in Q1 of 2024. Net income, look at that. Q4 of 2022, 55 million. They're expecting 2 billion in Q1. They did 938 last quarter. Awesome stuff. Now, global streaming paid memberships. Look at this growth. 230, 232, 238, 247, 260. Huge, huge jumps. These are amazing jumps for such a big company that's already in so many homes right now. And for the granddaddy of them all, free cash flow. 332 in Q4 of 2022, going to 2 billion, 1.3, 1.9, 1.6. So you might sit here and say, wait a second, this is declining. Well, remember, there are going to be ups and downs here. But I do believe as they add more users, they're going to get much, much better on their financials. Isn't it amazing that a company that's already so big can add 13 million users in a quarter? That's incredible. And that speaks to how Netflix is more ingrained in our lives. When my wife and I go to bed at night, we want to watch something, we immediately go to Netflix first. That's our first go-to is Netflix. If we don't find anything there, then we look at the other lists of things we watch. It's ingrained in our life. Now, let's go take a look at 3M and Netflix from our perspective financially. So here's 3M from our 8-pillar perspective. We've got a 5-year PE ratio of 17.7. Look at this, guys. 5-year price to free cash flow of 10. 10 on a company like this. Low return on invested capital, shares outstanding down 4%, cash flow has declined, net income has declined, revenue growth. Now, the net income, though, you got to remember, is because of these settlements they did, and they wrote off all those settlement charges up front. For those people who love dividends, look at this dividend yield. 6.2% eats up 3.3 billion of their free cash flow, and their cash flow in the last year, guys, they're returning a lot of money through dividends. So if you're a dividend player, this could be a great company for you if you like the rest of the picture. The debt level, a little bit higher than I'd like. That's one issue I have with 3M. I don't like their debt level. Their market cap is 53 billion. And their enterprise value is 93. That difference of 40 billion is essentially the debt on board. I don't like that at all, but let's check out Netflix now. So here we go on Netflix, guys. Another 4 X's and 4 checks. High PE, 59, really high price to free cash flow. Remember I told you before, I didn't like that their free cash flow and their earnings were so different, but look at this. Last year's free cash flow, 5.7 billion. Net income was 4.5. It's finally starting to turn where the free cash flow is coming in. And that's a very positive sign for the company. This doesn't even include last quarter, so it's probably going to be even higher than that, which I love. No dividend, makes perfect sense, but a decent return on capital, okay? A lot of debt relative to free cash flow. Remember, their 5-year free cash flow is 869 million. If you take them to today's number, the last 12 months, that makes this metric of long-term liabilities to free cash flow much, much lower. So I'm okay with this being an X, not bothering me. 0.79% of shares outstanding increase doesn't bother me. So really the only issues I have are valuation. Now, the 1-year price of free cash flow is 39. Is that reasonable? That's the question you have to ask. So what price am I willing to pay for these two companies? Guys, full disclosure, I own 3M. I have it. It's a play that I have. I bought the stock somewhere sub 90, went up to 100 and some. Now it's back down to 95. Here are my assumptions of the company, 1, 3, and 5%. You can take a look at these. More detail on the screen, 10, 12.5, 15% profit margin. Free cash flow, 12, 14, 16, 15, 17, 19 on the PE ratio and the price of free cash flow. And I did 10% on the low side for return, 12.5 in the middle, 15% on the high side for my margin of safety. The stock's currently at 96. It's on my watch list at 90 because I'm going to add to it sub 90 because I'm looking at this going, hey, okay, it might make sense for a lot of people that dividend's attractive, but they're not going to be able to grow their profit a lot and very quickly. I'm hoping they buy back a lot of shares and make me a bigger owner of the company as time goes on. Here's an unpopular opinion. Stop paying the dividend. Cancel that dividend. Start buying back shares and start paying down that debt. Let's check out Netflix now. Stock analyzer tool. This might be a little conservative. I did 3, 6, and 9%. Let's see what analysts are expecting for revenue growth. Yeah, I'm being way too conservative here, probably. So I'm going to sit here and do 5, 8, and 11% revenue growth for the next 10 years. Profit margin, it's increasing, guys. So let's do 13. I'm readjusting my numbers here. That's what you do. New information has come in. I'm readjusting my analysis of the company. They're starting to show a better ability to make money. And I like that. I'm going to do 13, 16, and 19% on both net profit margin and free cash flow. PE, I'll do 15, 18, and 21. And for my return, I still want a little bit of juice even on the low side. I'm going to put 11, 13, and 15%. Hit the analyze button. The stock's currently at 530. I have a low price of 146, a high price of 308, a middle price of 215. I don't own it yet. Guys, I'm sticking with my 3M for now, but don't ever buy a company because somebody has it themselves. Do your own research. And if you want to be able to have these tools and this experience and the community to talk about these, free 7-day trial for all of our software here, full access, everythingmoney.com, full 7-day, full free access trial. Thank you very much.